Welcome to the Deep Dive. Today, we're looking at an earnings call that wasn't really about earnings in the usual sense.
Not at all.
We're digging into Elme Communities' second quarter 2025 results from August 6th. And really, this call marked a huge strategic shift.
Yeah, it was less about Q2 operations and much more about the announcement of a complete plan of liquidation, a total wind down.
Exactly. So our mission today isn't just reviewing numbers, it's dissecting that pivot.
Right. We want to get straight to the liquidation plan, the numbers involved, and what it means. For you listening, this is about understanding how they plan to return, about $1.7 billion to shareholders?
That's the core of it. Okay, but let's quickly touch on the actual Q2 results first, just to set the stage.
Sure, context matters.
So Core FFO per share came in at $0.24. That was actually a beat.
Yep, consensus was $0.23, so about a 4.35% beat there. Small but positive.
Revenue was also a bit ahead, $62.1 million against estimates in the $61.4 to $61.6 million range. That's about 3.3% growth year over year.
And DAP EPS was basically in line at negative 0.04 cents.
So operationally, things looked stable, maybe even slightly better than expected.
Right. The assets were performing. But here's the kicker. The market reaction.
Yeah, what happened there?
The stock actually dropped slightly. Down almost 0.9% on the day of the call, and on heavy volume too.
Which tells you?
It tells you trading wasn't about that small operational beat. It was entirely about the strategic announcement that came out just before the call, the liquidation plan.
The fundamentals only mattered insofar as they showed the assets were, well, sellable.
Precisely. Good assets make for an easier liquidation. The market was already pricing in the wind down.
Okay, let's dive into that strategic pivot then. The big news was the formal conclusion of the board's strategic review.
Yeah, and it resulted in a two-pronged plan. It's pretty definitive.
Okay, what's prong one?
Prong one. They signed a deal to sell 19 communities, a big chunk of the portfolio, to Cortland.
For how much?
$1.6 billion. All cash.
Wow, and when does that close?
Expected in Q4 this year, so pretty soon. But it is subject to shareholder approval, obviously.
Naturally.
Okay, and prong two.
Prong two is the board okaying a voluntary plan to sell and liquidate all the remaining assets. Everything else goes.
So this wasn't just selling a part of the business. This is a full dissolution.
Full dissolution. End of the company as an operating entity.
What was the rationale management gave? I mean, they spent years building this focused multifamily platform. Why liquidate now?
Well, the official line was, despite their success in building the platform, the current market environment made it really tough to lower their cost of capital enough to scale accretively.
Meaning?
Meaning their stock price was likely trading well below what the actual properties were worth in the private market. So issuing stock to buy more buildings would have hurt existing shareholders. Growing was becoming value destructive.
And they tested the market pretty thoroughly, right?
Oh, yeah. They mentioned contacting over 80 different counterparties, other REITs, private equity, pension funds, the usual suspects.
And the feedback was, the clear consensus from that process was that liquidation, selling everything off piece by piece, was expected to deliver the highest value back to shareholders, more than staying public, more than selling the whole company to one buyer.
Worth more dead than alive, essentially.
That's the classic phrase, and it seems to apply here.
And as a result, no more guidance, right?
Correct. They pulled all their previous 2025 guidance and said they won't be issuing any new outlook for 25 or 26. The focus is now purely transactional.
Makes sense. Okay, let's get to the numbers everyone was waiting for. The liquidation math. The bridge, as they sometimes call it.
Right. This is the key part for investors now. The estimated total payout, the aggregate distribution, is expected to be somewhere between $17.58 and $18.50 per share.
Okay, that's the total target range. That's pretty specific.
It is, and it gives investors a clear target to anchor on.
What drives the difference between the low end, $17.58, and the high end, $18.50? Is it mostly just costs or uncertainty about final sale prices?
It's a mix, but probably weighted towards the final sale prices for the remaining assets, especially the office building, Watergate 600, plus potential transaction costs, reserves, things like that. Minimal leakage is the goal.
And a big chunk of this cash comes relatively soon.
Yes. After that Cortland deal closes in Q4, they plan to declare an initial special distribution.
How much are we talking for that first payout?
They estimate that initial distribution will be between $14.50 and $14.82 per share.
Whoa. So the vast majority of the total expected return could hit shareholder accounts by early next year.
Exactly. That's funded by the net proceeds from the Cortland sale, plus some new debt they plan to put on the remaining assets before selling them.
And the rest, the final stub.
The sale of the other 9 multifamily properties in that Watergate office building is expected to generate the remaining amount somewhere between $2.90 and 50 cents per share.
What about taxes on these distributions? Did they comment on that?
They did. The general expectation is that these distributions will be treated mostly as a return of capital, at least up to your original cost basis in the stock.
So tax deferred for many investors until they've gotten their initial investment back.
Pretty much, yeah. Any amount you receive above your basis would then typically be treated as capital gain. That's a pretty attractive feature.
Okay, and the timeline for selling off those remaining assets?
They're kicking off the marketing process for those in Q3.
Great.
So right about now. And the goal is to get everything sold within the next 12 months.
An aggressive timeline, especially given some of the assets. Which brings us back to asset health. Even in a liquidation, buyers want decent properties.
Absolutely. And the Q2 results suggest the portfolio is pretty solid. Same-store multifamily NOI grew 4.5% year over year. That's healthy.
Occupancy.
Strong. Average occupancy was 94.7%, actually up slightly, about 20 basis points from last year. Buyers like to see stable, occupied buildings.
What about rent growth? That seemed a bit mixed.
It was. Blended lease rate growth was positive overall, but only just, at 1.3%.
Driven by?
Driven entirely by renewals. Existing tenants renewing their leases signed up for pretty strong increases, 4.9% on average.
But new leases?
Softer. New lease rates were actually down 3.3%. So they have pricing power on renewals, but they're competitive, attracting new tenants right now in their markets.
And those markets are primarily in the DC metro area, right? Did the Q&A give any color on geographic differences? That's important for valuing the remaining assets.
It did. They noted that the Virginia and Maryland portfolios saw pretty good blended lease growth, thanks again to those strong renewals.
But DC itself?
The properties in the District of Columbia were described as more flattish overall. That weakness in new lease rates seems to be hitting DC proper a bit harder. Something potential buyers of those specific assets will definitely note.
And then there's the office building, Watergate 600, always the outlier.
Yeah, that's the wild card in the final distribution number.
Yeah.
Management said it's 82% leased, and they expect to kind of stay there through year end. But they also mentioned they're still in talks with the largest tenant. The outcome of that negotiation is pretty critical for the building's value and saleability. Selling an office building right now is tough enough. Uncertainty around the main tenant makes it harder.
Definitely adds risk. Speaking of risk, they talked about regulatory hurdles impacting that 12-month sale timeline. Can you unpack acronyms like TUTOPA and HOSC for us?
Right. This is crucial for understanding the execution risk, especially for the DC and Maryland assets. TPA is the Tenant Opportunity to Purchase Act in DC.
Meaning tenants get first dibs.
Exactly. Before they can sell an apartment building to a third party like Cortland or whoever buys the rest, they first have to offer it to the tenants under specific terms and timelines. The tenants can form an association, try to secure financing. It can add months of delay and uncertainty.
So it's not just a formality.
Not at all. It's a significant procedural step. And then in Montgomery County, Maryland, you have HOSC, the Housing Opportunities Commission. That involves another set of requirements, often related to affordable housing components, that have to be navigated before a sale can close.
So these regulations add real time and complexity.
Absolutely. Management explicitly said they factored these hurdles into that 12-month timeline estimate, which is good. It shows they're being realistic. But it also highlights why this isn't just a simple, quick wind down. There are potential bumps in the road.
Good to know. And financially, the company is stable enough to handle this process.
Seems so. They reported liquidity of about $330 million, and net debt to adjusted EBITDA was around 5.6 times. That's manageable. It's not a fire sale driven by financial distress.
And the underlying DC metro market helps too, right?
Yeah, that's a supporting factor. They mentioned rent growth in the DC area is actually outpacing the national average right now. Plus, things like projected defense spending increases could provide some economic cushion for the region. All that helps support the value of the assets they're trying to sell.
Okay, so pulling it all together, the investment thesis for Elme has fundamentally changed.
Completely. You're no longer evaluating it as an ongoing apartment REIT based on FFO multiples or growth prospects.
It's now about...
It's basically an arbitrage play on the liquidation value. It's about execution risk and timing. Can management hit that $17.58 to $18.50 per share distribution range within roughly the next year?
The entire focus is on closing the Cortland deal, selling the rest without major hiccups, and keeping those transaction costs and reserves tight.
That's the whole game now.
All right, that brings us to our segment. This is not financial advice. Just a reminder, this discussion is purely for educational purposes, helping you understand the information from the call. We are not recommending any specific trades.
Got it. Okay, so let's look at the potential setup here, purely analytically. The stock closed around $16.25 on the day of the earnings call.
Right.
And the company itself guided to an expected total payout between $17.58 and $18.50.
So there's a gap.
There's a gap. Call it $1.33 to $2.25 per share of potential upside between the trading price then and the company's projected liquidation value.
So what's an outrageous but plausible trade idea based on that gap?
Okay, here's one way you could think about it. Go long Elme equity, specifically aiming to capture that $1.33 to $2.25 liquidation premium over the next 12 months or so.
But there's risk, right? Execution risk, market risk.
Exactly. So to maybe hedge some of that, particularly risks tied to the DC real estate market or delays from things like TOPA, you could potentially pair that long Elme position with a short position.
Short what?
Maybe a small basket of other DC area apartment REITs, specifically ones that are not liquidating and maybe carry higher leverage. The idea would be to isolate the Elme-specific liquidation execution.
So you're betting primarily on Elme Management's ability to deliver on their stated plan, on time and within budget, while hedging out some broader market factors.
That's the concept. It becomes a bet on transactional certainty versus ongoing operational uncertainty elsewhere. Again, not advice, just analyzing the setup.
Understood. A sharp thesis focused purely on the wind down. So let's wrap this deep dive, the absolute key takeaway.
Elme is no longer an operating REIT. It's a liquidation story. Full stop. They have a clear plan to return $17.58 to $18.50 per share, mostly within the next year.
And the final provocative thought for our listeners.
It's this. Management has basically told you the liquidation value range upfront. And a huge chunk of that cash is coming relatively soon from the Cortland deal. So the question becomes, how much of a discount should the market apply for the remaining execution risk? The risk tied to selling Watergate 600, navigating 2PA, potential cost overruns. What discount adequately compensates for that uncertainty?
That calculation, how much risk is priced in versus the potential reward, is really the heart of the investment decision now, isn't it?
Absolutely.
Yeah.
That's the number you need to wrestle with if you're looking at this situation.
Something to definitely think about as we watch for that Cortland deal to close later this year. Thanks for joining us for this deep dive into Elme's big pivot.